Picture this: you're sitting alone in a modest home office late at night, coffee cup half empty, laptop flickering with stock tickers, financial headlines flashing warnings of market correction or bubble about to burst. You feel the familiar churn in your gut, anxiety mingled with anticipation. Somewhere out there, a handful of investors are quietly pocketing fortunes, moving in and out of positions with surgical precision, like chess masters thinking 10 moves ahead. What do they know that you don't? What hidden rules, unspoken strategies, and behind closed doors agreements exist beyond the reach of public blogs and glossy finance magazines? Tonight, you're about to learn the secret money rules smart investors never share until now. Long before the rise of algorithmic trading and smartphone brokerages, investing was a closed club. You needed telephone lines in boardrooms, insider introductions, or a seat at exclusive dinners to even hear whispers of the next big deal. Decades later, technology has flung open the doors, but the deepest truths remain shrouded behind silence, proprietary models, and unrecorded phone calls. It's not that today's masters want to withhold knowledge out of malice. In many cases, it's self-preservation. Revelation of a secret tactic dilutes its edge, forces markets to adapt, and ultimately robs those who first discovered it of its power. Over time, smart investors have assembled a toolkit of rules so counterintuitive, so easily misunderstood, that only the boldest and most diligent are willing to apply them and survive. To understand why these rules exist, imagine markets not as fair arenas of equal opportunity, but as ecosystems of information asymmetry. Some players have research teams of seasoned analysts, channels to corporate executives, and decades of institutional memory. Others rely on quarterly reports, public filings, and the same news feeds you see every morning. That gap, this gulf of privileged insight, creates the playground where the silent winners move. But what if you could close some of that gulf? What if you could adopt the mindset and hidden guidelines of those who refuse to broadcast their secrets? Over the next chapters, we'll dismantle the myths, expose the overlooked strategies, and reveal the turning points that define wealth creation at the highest levels. We begin with the principle Warren Buffett himself hinted at when he said, "Price is what you pay, value is what you get." The first unspoken rule in the Sorcerer's Tower of Finance is simple on the surface but devilishly hard in practice: seek asymmetric bets. Rewards far exceed risks only when your downside is limited, and your potential upside is massive. Think of options as the private handshake of pros. To the uninitiated, they look like exotic gambling complex Greek letters: time decay, implied volatility. In truth, options are insurance contracts written against your own capital, granting you the right but not the obligation to buy or sell at a predetermined price. Savvy investors craft option positions to cap losses at a fraction of the premium, while multiplying gains if the underlying asset surges. It could be a small, well-priced call on a biotech company awaiting FDA approval, or a protective put on a blue-chip index when data points hint at an inflection. The key is never overpaying for optionality, and always sizing positions so a string of small losses won't wipe you out. Consider the tale of a hedge fund manager named Clara Zhang, a relative newcomer who built a $2 billion portfolio in under 5 years. The secret to her meteoric rise wasn't a magic formula, but rigorous screening for mispriced events, merger arbitrage with a twist. Whenever a takeover was announced, the stock typically converged toward the offer price almost immediately. Most traders arbitrage that spread until it vanishes. Clara, however, bought deep out of the money call options on the acquirer, betting on the deal's completion, driving not just share price alignment but also broader market sentiment toward the sector. By risking just 2 of her fund on each event, but capturing 10x returns in successful deals, she maintained a portfolio that could absorb multiple misses yet still vault toward double-digit annual gains. Next, let's walk into the emotional minefield where many retail investors stumble: fear and greed. We've all seen the headlines: market crash looms, buy now before prices skyrocket, and felt our hearts race. Behind every crisis, there's a cadre of professionals nudging asset prices with subtle pushes. They feed narratives into social media, plant op columns, and even leak exclusive rumors to local news outlets. This is rule number 2: never trust consensus. When 80 of investors are bullish, it's time to look for the smart money flowing out of the hot sector. During the 2008 housing meltdown, a small group of institutional shorts started quietly buying credit default swaps on mortgage-backed securities months before most headline writers acknowledged any systemic risk. Their names, like John Paulson, later became legendary, but at the time, those trades were derided as alarmist. The lesson: genuine contrarian insight often masquerades as paranoia to the masses. Fear, however, is just one half of the equation. Greed, that blinding attraction to shiny assets, is equally toxic. In the frenzy of dot-com mania, or the speculative frenzy around meme stocks, retail investors pump money into highly liquid hyped equities, only to see valuations collapse. But insider players navigate this mania by writing covered calls on their holdings, essentially selling off a piece of their unwanted upside in exchange for immediate premium. They lock in gains automatically rather than hoping to time the peak. Publicly, these investors are hailed as prescient cashouts. Privately, they're following a rule that turns mania into a revenue stream. Over decades, collecting small premiums in frothy markets can dwarf the occasional jackpot hit. Our third secret rule centers on hidden pockets of value outside of headline equity markets: debt, derivatives structured as convertible bonds, and private placements that never make it to public lists. During the Eurozone debt crisis of the early 2010s, a handful of distressed debt specialists built staggering fortunes by buying bonds of struggling sovereigns at fractions of face value, negotiating restructuring terms, and then watching yields normalize. To the average investor, sovereign debt is outside the realm of possibility, too large, too opaque. But by pooling capital in boutique funds and co-investment vehicles, professionals gain access to deals with embedded yields of 12, 15 or more, even as the face value suggests a safe Ashhouse's rating. These are not get-rich-quick schemes. They require deep legal expertise, cross-cultural negotiation skills, and the patience to see deals through multiple rounds of restructuring, sometimes over decades. A fourth unspoken truth holds even more transformative power: the compounding effect of tax optim. Every millionaire you've ever heard of, every billionaire has a carefully crafted tax playbook. It isn't about illegal evasion, it's about using structures, jurisdictions, and instruments to defer or convert taxable income into lower tax liabilities. Real estate investors leverage 1031 exchanges in the United States to swap properties without immediate capital gains. Family offices funnel capital into opportunity zone funds, pausing the tax clock on gains until as late as 2047, while accessing up to 15 exclusion. Some high net worth individuals even create captive insurance companies, yes, insurance, where they self-insure business risks and accumulate reserves that grow tax deferred. These reserves can later be deployed back into the market or used to fund new ventures entirely free of ordinary income tax rates. For most retail investors, these are distant abstractions. For the inner circle, they underpin the difference between 8 and 15 net returns over decades. Then comes the turning point, the secret that redefines everything you thought you knew about investing: alignment of incentives. It's not enough to find undervalued assets, master emotional cycles, or optimize taxes. True legendary investors structure every deal so that the counterparty or partner is just as committed to success as they are. Sequoia Capital's term sheets, for instance, demand founders hold substantial equity stakes through multiple funding rounds, ensuring both sides bleed and triumph together. Private credit deals often include covenant protections that penalize management for underperformance, tying fees to metrics that matter most: cash flow, EBITDA growth, or user engagement, not vanity metrics like registered accounts. On the retail side, few know that some mutual funds embed performance fees that kick in only after beating benchmarks by a certain margin. Such structures aren't advertised because they reduce asset gathering in the short term, yet they align managers' upside with investors' rewards. As the dust settles on these revelations, a deeper truth emerges about human nature and markets. People crave certainty in an uncertain world, and they cling to simple formulas: buy low, sell high, dollar cost average into this index. But real fortunes arise in gray areas where discipline marries innovation and secrecy fends off complacency. These hidden rules remind us that knowledge alone isn't enough. It's the disciplined application, the willingness to stand apart from consensus, and the art of creating win-win structures that ultimately reaps outsized rewards. So where does that leave you? The home office trader, the curious learner, the aspiring professional? Start small but think like a giant. Treat every position as if it's a tiny business, with balance sheets, risk controls, and exit strategies. Ask yourself not only how much you could lose, but who else stands to gain or lose alongside you. Study the legal and structural quirks that move millions in dark corners of finance: convertibles, structured notes, tax advantage vehicles, and ask whether you can access analogs in your own account. Above all, never stop questioning consensus narratives, for true edge hides where the crowd is most deaf and blind. In the end, the money rules smart investors never share aren't secret because they're mystical. They're secret because commitment and discretion are more valuable than bragging rights, and because every advantage erodes once it becomes common knowledge. Now armed with these insights: option asymmetry, contrarian fear, greed, mastery, hidden market arbitrage, tax-optimized compounding, incentive alignment. You hold a roadmap few ever see. The real question isn't whether you'll take the path less traveled, but whether you have the patience, courage, and humility to walk it. What will your first step be? Let us know in the comments below. Your future self might thank you for the secret you finally chose to unlock.